Welcome to the deep dive. Today we're really getting into the details of Adani Power Ltd, or APL. We're looking at their Q2 results for fiscal year 2026 and, maybe more importantly, their big plans for future expansion. This is all based on their latest reports in the conference call from October 30th, 2025. Yeah, our mission today is to figure out how APL plans to, well, almost triple their power generation capacity. They're talking about going from around 18 gigawatts now to a massive 42 gigawatts by 2032. And the big question is how they manage that kind of growth financially and practically, especially given some recent market choppiness.
Right, and that context, the operating environment, is really crucial for understanding their Q2 performance. It wasn't an easy quarter. The sources kept mentioning this unprecedented early and prolonged monsoon.
Okay, a long monsoon. How does that impact a power company?
Well, it hits them in two main ways. First, overall power demand drops, think less air conditioning needed. And second, it pushes down merchant power tariffs. Those are the short-term market rates, and they got quite low. So, yeah, it was a pretty challenging backdrop.
Okay, so that sets up an interesting point right away.
Yeah.
You're saying the conditions were tough, demand was down, yet the reports show APL actually grew its power sales volume. How does that work? If the market's weak, how did they sell more power?
That's the interesting part. They managed it because a huge chunk of their capacity is tied up in long-term contracts, PPAs. So while the monsoon was hitting the, let's say, the day-to-day spot market, their core contracted revenue streams were pretty stable. We saw their sales volume climb over 7% compared to last year, reaching 23.7 billion units.
Okay. So the long-term deals provided a buffer.
Exactly. And you see that stability reflected across their financials for Q2. Their total continuing revenue was basically flat, holding steady at 13,639 crores. A slight growth, actually. And the key profit metric, continuing EBITDA, was also very resilient. It came in at 5,333 crores.
Pretty stable then.
Very stable. And that comes down to, well, running their plants efficiently and critically having those solid power purchase agreements in place.
So those PPAs really are like a financial shield against those immediate weather shocks. But surely the bad weather must show up somewhere in the numbers.
Oh, absolutely. You see it clearly in their operational efficiency metric, the plant load factor, or PLF.
Right, the PLF tells you how much the plants are actually running.
Precisely. And it dropped. You went from about 66.9% in Q2 last year down to 62.8% this Q2. That dip, that's a direct reflection of the lower demand caused by that long monsoon. The plants just weren't needed as much.
Got it. So operationally, less busy, but financially protected by the contracts.
You could think of it like an airline, maybe. Bad weather cancels some flights, so your planes aren't flying as much. That's your PLF dropping. But if, say, 90% of your income comes from long-term cargo contracts that are already locked in, your overall profit doesn't really take a hit. That's kind of the model APL's built.
That makes sense. Okay, stability handled. But now this expansion plan, adding 24 gigawatts is just huge. That needs a lot of money. What does their debt situation look like as they embark on this? Are they loading up?
Well, yes, the debt has gone up. You'd expect that with such a massive capital expenditure program starting. Total debt rose to 47,254 crores. That's up from around 38,335 crores back in March 2025. The company commentary confirms this is mostly bridge financing.
Bridge financing. Okay, maybe explain that quickly for listeners.
Sure, it's basically short-term funding. They take out loans now to cover the immediate costs of starting these big projects, with the plan to replace it with longer-term financing or internal cash flows later on.
Standard practice for big builds then.
Pretty standard, yes. But the key thing markets watch is leverage how much debt relative to earnings. And here's the reassuring part. Their net debt to continuing EBITDA ratio, even with the new debt, is holding steady at 1.75 times.
So they're taking on debt, but their earnings are keeping pace, so the relative risk level isn't spiking.
Exactly. They seem to be managing it well so far.
Okay. And one last housekeeping note for people tracking the stock. The 1-for-5 stock split happened in September, right? Face value down to €2 per share.
That's right. Completed September 22nd. More of a technical adjustment, really.
Okay, let's shift gears fully to the future now. The gigawatt roadmap. 42 gigawatts by 2032. That number is just staggering. How are they actually building this pipeline? And what's the mechanism letting them win such big chunks of new capacity contracts?
The main mechanism here is a government policy called SHAKTI.
Is AUTA, okay.
Yeah, this policy basically helps the power ministry allocate coal linkages, and, crucially, it sets up the framework for states to hold competitive bids for these long-term PPAs. It kind of streamlines the whole process and often includes government backing for the fuel supply, which is a big deal.
And APL's been doing well under this policy.
Exceptionally well. The reports say that out of about 14.5 gigawatts awarded by various states through SHIX-IT so far, APL has bagged long-term PPAs for over 9 gigawatts.
9 gigawatts.
Yeah.
That's half their current operating base right there, just in new contracts secured.
It is a huge win rate.
What kind of projects are these new contracts for?
So the recent big ones mentioned were a 2,400 megawatt PPA in Bihar and another 1,600 megawatts in Madhya Pradesh. Both of these are greenfield projects, meaning building from scratch on new sites. And they're specified as ultra-supercritical thermal power projects.
Ultra supercritical. That
Yeah.
sounds important. What does it mean practically?
It basically means they're using the most modern, efficient coal-burning technology available. These plants run at very high temperatures and pressures, so they burn less coal to generate the same amount of electricity compared to older plants. Higher efficiency, slightly better on the emissions front for coal power.
Okay, higher efficiency. But it still brings up the question, doesn't it? This is a massive multi-billion-dollar bet on coal power for the next decade. We hear so much about the push for renewables. Did the sources address this? I mean, investing 2 lakh crores in new thermal capacity? Is there acknowledgement of that potential long-term risk?
It's a fair question. The company's perspective, as presented in the sources, frames this less as an either with renewables and more about providing essential baseload power for the country. We can circle back to this, but the argument is that India needs reliable 247 power that, frankly, renewables alone can't yet guarantee consistently. Thermal power fills that gap.
Reliability factor, okay.
And on the financial risk side, they're tackling it head-on through the PPA structure and really through incredible upfront preparation. That total cost you mentioned, roughly 2 lakh crores.
Which is about, what, 24 billion US dollars, give or take?
Yeah, around that mark, a huge sum. They plan to fund a good chunk internally from their operations, using that bridge financing we talked about to cover the gaps until cash flow ramps up or they secure longer-term debt.
Right. But the real story seems to be how they're trying to prevent delays. We all know Indian infrastructure projects can get bogged down for years, land issues, equipment holdups. How is APL planning to avoid that for this massive 42 gigawatt target? What's the de-risking strategy?
This is where it gets really impressive, actually. The de-risking is very proactive. They've tackled execution, capital, and fuel supply right at the start. So on execution, land acquisition is often the biggest hurdle, right?
Definitely.
Well, they state they have 100% land availability secured for this entire 23.5 gigawatt expansion pipeline.
100%. How?
Mostly by focusing on brownfield development. That means building the new units right next to their existing power plants. It avoids nearly all the red tape involved in acquiring completely new land parcels.
Ah, smart. That saves enormous amounts of time and potential legal battles. What about getting the actual machinery? Turbines, boilers aren't there global supply chain issues?
They've addressed that too. They report 100% advanced ordering for all the critical equipment, the boiler, turbine, generator sets, the BTG packages.
So the orders are placed, production slots booked.
Exactly. It's not just an intention to buy. It sounds like the contracts are signed, deposits paid, manufacturing slots secured with the major global suppliers.
Wow. Okay, that is a powerful move. It suggests they have serious clout with suppliers, and more importantly, it potentially neutralizes a huge delay risk that hits so many other big projects right now.
It absolutely does. It signals real confidence in their funding and their execution timeline. And the final piece of de-risking is the fuel. For these new PPAs, one under Chef KAT, the fuel linkage, the coal supply, is essentially guaranteed by the utility that awarded the contract. And critically, the price of that fuel is a complete pass-through in the PPA.
Pass-through means if coal prices shoot up next year.
APL doesn't bear that cost increase. It's automatically passed on to the electricity buyer, the state utility, according to a set formula in the contract.
So zero fuel price risk for APL on these new projects.
Correct. It makes their revenue incredibly predictable no matter what happens with global coal prices. This whole focus on locking in certainty explains their overall PPA strategy.
They're deliberately choosing predictable income over the potential upside, but also the downside of the volatile merchant market.
Precisely. And we saw why in the Q2 numbers.
Let's revisit those numbers quickly. How much of their current capacity is under PPA?
Right now, it's 91%. That's about 16,700 megawatts out of their total 18,150 megawatts. And management explicitly said they want to push that even higher, aiming for maybe 92 or 93%. Minimize that merchant exposure.
And the Q2 merchant price really showed the risk, didn't it?
It did. Their average realization on the merchant market was only 5.37 per unit. Compare that to 5.88 they got in the same quarter last year.
That's a noticeable drop, almost 10%.
Yeah, a 51 pays drop per unit. It really underscores why locking in PPA rates is attractive, even if they're sometimes lower than peak merchant prices. They do think merchant rates might recover a bit in the second half of the year, maybe back towards 6.0 as demand picks up seasonally, but the strategy is clearly geared towards long-term stability.
Okay, so the financial strategy is clear. Lock it down with PPAs. But the success of the whole 42 GW plan still rides on actually building these things on time and on budget. Can we look at some operational examples that show their execution muscle? You mentioned the Godad plant in VIPL earlier.
Right. Goda is the plant supplying power across the border to Bangladesh under a specific PPA. Its performance is strong. The PLF there is around 72%, which is actually quite a bit better than the average for coal plants in India right now.
And crucially, are they getting paid by Bangladesh? Cross-border deals can sometimes have payment delays.
Seems very healthy, according to the report. Receivables are good, only about 1.5 months of payments outstanding, and only half a month technically overdue. For this kind of large international deal, that's considered very smooth.
Okay, solid execution there. But the VIPL story sounded even more dramatic. Vidarbha Industries Power Ltd.
It really is quite something. So VIPL is a 600 megawatt plant, and it had been completely shut down, mothballed for almost 10 years, just sitting idle.
10 years offline. Okay.
APL acquired it in July 2025. And within just 2 months, they had refurbished it, fired it up, and brought it back to full operation.
Wait, hang on. 2 months? To revive a power plant that was dormant for a decade?
That's what the sources indicate. It speaks volumes about their technical team, their logistics, their ability to mobilize quickly.
That has to be the strongest piece of evidence supporting their ability to deliver on the huge expansion pipeline, right? If they can do that in 60 days.
It certainly demonstrates a remarkable capability to, well, assess an asset, acquire it, fix it, and get it running incredibly fast. And they didn't just get it running, they immediately secured a 500 megawatt PPA for most of its capacity with the Maharashtra State Utility for 5 years.
Oh, acquire, revive, contract. Fast.
Exactly. Turned a dead asset into a stable, revenue-generating one with a long-term contract almost overnight. It perfectly illustrates their whole approach.
Impressive. Okay, just one more detail before we wrap up. There was something about simplifying the company structure.
Yes. The board approved a plan to merge 10 of their wholly owned subsidiary companies directly into the main Adani Power Ltd entity. This took effect retrospectively from April 1st, 2025. It's basically internal housekeeping.
Makes sense. Why do that now? It's likely to streamline management and governance. When you're planning to operate a massive 42 gigawatt portfolio spread across the country, having a simpler, unified corporate structure probably makes things a lot easier to manage efficiently. Sets the stage for growth. Okay. So this has been a really insightful deep dive. We've seen a company that's, on one hand, financially insulated itself pretty well from short-term market shocks.
Through those PPAs.
And on the other hand, is launching this incredibly ambitious expansion plan, but doing it in a way that seems intensely focused on removing risks before they happen. So summing it up for you listening. 2 big takeaways. First, APL's business model, heavy on long-term contracts, proved very resilient in Q2 FY26 against those weather disruptions. The PPAs worked as designed.
Definitely. And the second key takeaway is just how aggressively they're de-risking that huge 42 gigawatt expansion plan for FY32. It's not just a target. They've apparently locked down 100% of the land needed, mostly brownfield. They've placed 100% of the orders for critical equipment. And the fuel price risk on new projects is neutralized by pass-through clauses. It's about execution certainty.
And connecting this back to the bigger picture in India, you touched on this earlier. Why are states still signing up for so much new thermal power when the national focus includes a huge 500 gigawatt renewable target by 2030?
It really comes down to that word, baseload, reliability. Solar and wind are fantastic and growing incredibly fast, but they are intermittent. They don't produce power 24/7. The government's own projections, even factoring in the massive renewable push, still forecast a need for something like 80 gigawatts of additional coal-based capacity by 2032.
80 gigawatts more coal needed, even with 500 gigawatts of renewables.
That's the projection. Because you need that guaranteed power, especially during evenings or when the weather isn't right for renewables. Thermal power provides that essential grid stability. It ensures the lights stay on, always.
So APL is essentially positioning itself as a major provider of that necessary stability for the Indian grid over the coming decade.
That seems to be the strategic play, yes. Filling a critical national need for reliable power.
Which leaves us with a final thought for you to chew on. We've seen the certainty built into APL's new contracts, especially the fuel cost pass-through. We've seen their demonstrated ability to execute quickly, like with VIPL. So the question is, how much will APL's current expansion strategy, with its focus on de-risked execution and predictable costs, end up shaping the overall stability and perhaps even the price structure of India's entire power grid over the next 10 years? Something to think about.